Following the Swiss president's failure to reduce tariffs on her country after a visit to Washington earlier this week, the Financial Times is reporting that the U.S. has imposed tariffs on imports of 1 kilo gold bars, dealing a further blow to Switzerland, which is the biggest player in gold refining.
In early August 2025, Washington sent a jolt through the global markets. President Donald Trump's administration confirmed a 39% tariff on imported gold bars, hitting Switzerland, the world's largest gold refining hub, head-on. It wasn't just a blow to a small European country's exports. It was a message. No commodity, however entrenched in global trade, is beyond the reach of Trump's tariff playbook. For Canada, watching from across the border, this was a clear warning. If gold can be pulled into the fight, so can other high-value sectors.
The only thing I can tell you from a European perspective right now is that all shipments are on hold. So basically, there's no trading of gold bars between the Atlantic.
Until the first week of August, traders believed bullion would be spared. Gold bars in the 400-ounce form for central banks, the 100-ounce size traded on COMEX, and the 1-kilogram standard used in Asia were assumed to be outside the scope of tariffs. That changed when a Swiss refiner received a formal letter from U.S. Customs confirming that under tariff code 7108-13550, these bars would face the full 39% duty. The immediate impact was severe. Gold shipments between the U.S. and Europe halted overnight. U.S. gold prices climbed above European levels, opening an arbitrage gap. According to U.S. trade data, imports had surged earlier in 2025, 43 metric tons in January alone, nearly double the average monthly U.S. refining output of 22 tons, as buyers tried to front-load shipments before any policy change. Now, those stockpiles are all that's left to bridge the supply gap. For the global gold market, this was more than a price shift. It was a sudden rupture in the supply chain. For Canada, the lesson is straightforward. Gold may not be a major export to the U.S., but the same logic could apply to Canadian strategic minerals, energy products, or even high-end manufacturing. Ottawa knows that even sectors long considered safe under USMCA can be targeted. The gold shock proved how quickly decades-old trade flows can be disrupted by a single enforcement letter. And with Trump's focus on bilateral trade imbalances, Canada's own surpluses in certain commodities could attract the same kind of attention Switzerland just received.
We have a lot to do in this country. We have a lot positive to do in this country, building this country in a way, building one Canadian economy.
I have all the confidence in the world in the Prime Minister. Donald Trump is very, very hard to deal with just because it's so fluid.
This is why Prime Minister Mark Carney's approach carries even more weight in the current climate. While Ford hits back publicly with numbers, Carney is quietly keeping negotiation channels open, even as Canada faces the 35% rate. He is deepening trade cooperation with Mexico, expanding links with the EU, and safeguarding domestic industries against sudden U.S. policy shifts. Canada's leverage lies in what the U.S. needs: strategic minerals, energy, and integrated automotive supply chains. The gold tariff episode only reinforces Ottawa's push to diversify export destinations and prepare contingency plans. From steel and aluminum to copper, and now gold, Trump is targeting sectors where the U.S. can exert maximum short-term leverage. The element of surprise keeps opponents off balance. It's a tactic designed to push trade partners toward concessions before they can rally a coordinated response. But with Canada, the strategy has met resistance. Carney and Ford are aligned in rejecting a bad deal and in showing that Canada will not simply absorb U.S. pressure without a counterplan. For Canada, the gold tariff is more than a dispute with Switzerland. It's a warning shot. Ottawa is combining public pushback with measured diplomacy, signaling it won't be outmaneuvered. The contest is no longer about who can raise tariffs higher, but about who can adapt faster to the shocks still to come.
The fourth largest producer of oil and gas in the world, Canada exports 97% of its resource to the U.S. 60% of oil and gas that goes into the United States comes from Canada.
Donald Trump says he wants to protect American energy, but what if he's quietly weakening the very foundation of it? At a time when energy security is more important than ever, the U.S. still relies heavily on imported oil, and most of that oil, about 2/3, comes from one place, Canada. Yet Trump's own trade policies are threatening to disrupt that flow. How did we get here, where the United States needs Canadian oil more than ever, but Trump's strategy is pushing it away?
It seems not very exposed because it's the one thing the U.S. hasn't really put any tariffs on so far. I think they recognize they need our oil and gas to provide energy security for their country, and that if they tried to put a tariff on it, they'd still have to buy it. It would just mean higher consumer prices.
Canada supplies between 50% and 70% of all U.S. oil imports, averaging around 4 million barrels per day, according to the U.S. Energy Information Administration. This isn't just about volume. Canadian crude is uniquely suited for American refineries, especially those in the Midwest, which were built to process heavier oil grades, exactly what Canada produces. And unlike oil from OPEC nations, Russia, or Iran, Canadian energy comes from a stable, democratic neighbor. It's not subject to sanctions, political manipulation, or military conflict. Washington knows this. That's why, even as Trump imposed sweeping tariffs on Canadian steel, aluminum, and manufactured goods, he kept oil mostly exempt, for now.
The refineries will have to jack up prices if tariffs go on that oil. It could be 50 or 75 cents a barrel, and particularly the Midwest refineries in Minnesota and Illinois and some of those swing states.
But that exemption doesn't mean safety. Trump's trade doctrine is built on threats and uncertainty. As part of his hardline America First push, he's warning of 35% tariffs on all Canadian exports, oil included, if Canada refuses to sign a new bilateral deal. Currently, Canadian oil faces only a 10% tariff, but repeated threats of escalation have already shaken investor confidence. When companies can't predict tax levels or border access, they stop planning for long-term growth. According to ARC Energy Research Institute, total investment in Canadian oil and gas for 2025 is down 25% compared to the average of the previous 3 years. That means fewer drilling projects, fewer pipeline expansions, and no increase in supply to meet U.S. demand.
In Ukraine. So there's just so much uncertainty right now that for investors and for companies, it's very difficult to try to decide, are we going to, drill more wells, or are we just going to let it ride the way it is?
That slowdown is already hitting infrastructure. Canada's biggest export pipeline, Trans Mountain, is running near capacity. Major pipeline proposals like Energy East were canceled years ago, and with political risk and cost inflation on the rise, new projects remain stalled. To compensate, Canada is trying to boost output through short-term upgrades, but those are band-aids, not solutions. This bottleneck makes the U.S. energy system more fragile. A single disruption, whether from maintenance, weather, or sabotage, could tighten supply, spike fuel prices, and put refiners in a bind. Instead of shoring up a critical source of energy, Trump's policies are injecting risk, the opposite of energy independence. Facing pressure, Canada isn't backing down. Prime Minister Mark Carney has taken a firm stance. Canada won't sign a bad deal just to dodge tariffs. Carney understands the leverage. Trump can threaten, but he can't afford to lose Canadian oil. That's why Ottawa is buying time, holding the line, investing in domestic resilience, and reforming its energy sector to attract long-term capital again. At the same time, Canada is diversifying its trade partners, strengthening supply chains with Europe and Asia to avoid over-reliance on the U.S. market. Rather than panic, Canada is playing a longer, steadier game. Trump believes tariffs force countries to fold, but with Canada, his tactics are backfiring. He hasn't pushed Canada into a deal. Instead, he's triggered a pullback in energy investment, weakening a cornerstone of America's fuel supply. The irony is stark. In trying to make America stronger, Trump may be making its energy future more vulnerable. So the real question is, how can you win a trade war if your own energy supply is the first casualty?
A top Chinese official now says Beijing has agreed to extend its tariff truce with the U.S.
When Donald Trump's trade team sat down with Chinese officials in Stockholm this July, they came with the full weight of the president's strategy behind them. Just weeks earlier, Trump had sealed deals with both the European Union and Japan, agreements that embodied his vision of bilateral pressure and reciprocal tariffs. Now, facing Beijing, his negotiators expected that momentum to continue. But what they encountered wasn't resistance in the traditional sense. There were no walkouts, no dramatic threats. Instead, China responded with something far more deliberate, a soft but firm refusal to play by Trump's rules. They didn't walk away from the table. They sat there, listened, conceded a little, and then quietly defended their long-term position. This wasn't a retreat. It was a calculated delay.
So I think anyone who buys sanctioned Russian oil should be ready for this. Is a bill that will give the president discretion to apply secondary tariffs on sanctioned Russian oil from, I believe it's from 0 to 500%.
What was their response to that warning?
The Chinese take their sovereignty very seriously. We don't want to impede on their sovereignty, so they'd like to pay 100% tariff.
Washington came into the talks with a clear list of demands. The U.S. wanted China to cut its imports of sanctioned oil from Iran and Russia, commit to larger purchases of American goods, and reduce industrial overcapacity, particularly in sectors like steel and EVs. In return, the U.S. hinted it might delay or scale back planned tariffs. China, in response, lifted some of its restrictions on rare earth magnet exports, materials critical to U.S. defense and tech industries. But beyond that, Beijing made no promises. On oil, officials signaled they were prepared to absorb up to 100% tariffs if needed. On broader reforms, they kept their cards close. It was a clear message. China would give a little to buy time, but it would not concede its strategic posture. Rather than meet Trump head-on, Beijing chose to slow the pace. The two sides agreed in principle to extend their tariff truce, set to expire on August 12th. But no final deal was announced. U.S. officials confirmed that the pause still required Trump's personal approval. The message was subtle but powerful. China was willing to keep talking, as long as the terms didn't force them to restructure their economy on Washington's timeline. While the U.S. emphasized rebalancing trade and reshoring manufacturing, China remained focused on minimizing disruption. Instead of decoupling, they emphasized de-risking. And while Washington pushed for immediate commitments, Beijing focused on procedural cooperation, additional meetings, shared economic reports, and maintaining diplomatic space. This strategy gave China flexibility. It delayed confrontation and kept U.S. pressure in check without ceding too much ground.
And what's the biggest concession they've made?
That the Chinese have made? Well, I would say they blocked all of their rare earth magnets, and now we're getting them.
One of China's most powerful tools remains its dominance in rare earth supply. While it restored some flows of rare earth magnets to U.S. firms as a goodwill gesture, the underlying leverage remained. As of 2024, China accounted for over 90% of global rare earth refining capacity, according to data from the U.S. Geological Survey. That grip gives Beijing a built-in deterrent to any rapid escalation. Likewise, China's position on Iranian and Russian oil was deliberately firm. Instead of denying purchases, Chinese officials acknowledged the trade and accepted the possibility of penalties. In effect, they positioned themselves not as a violator, but as a sovereign actor willing to pay the price. This combination of partial cooperation and strategic firmness allowed China to hold its ground while avoiding the kind of direct conflict Trump's strategy often invites. Trump may have redrawn the map of global trade negotiations, but China isn't playing by the same map. At Stockholm, Beijing didn't fight loud. It fought long. Through limited concessions, strategic patience, and soft leverage, it resisted the core logic of Trump's deal-first model. While the White House sought fast results, China prepared for a longer game, one that tests whether Trump's system of pressure can withstand a counterpart who neither defies nor submits. In this round, there was no handshake, no headline deal. But beneath the surface, Beijing sent a clear signal. The rules may be changing, but they still get to choose when and how to respond.